Welcome to Dime Dive. Ever wondered how a personal loan can impact your credit score? Let's dive into this fascinating financial topic. Credit scores, those elusive three-digit numbers, have a significant impact on our financial lives. They're determined by several factors, including your payment history, amounts owed, the length of your credit history, new credit, and the diversity of your credit mix. Interestingly, around 10% of your score is based on new debt or newly opened credit lines. Personal loans fall under the category of new debt. When you acquire a personal loan, you increase your outstanding debt, which can influence your credit score. Credit agencies keep a keen eye on new financial activities, so if you apply for another loan shortly after taking a personal loan, there might be concerns about your existing debt load, which could potentially lead to denial of the new loan. But don't worry, it's not all doom and gloom. Your overall credit history carries more weight than a single new loan. If you've been responsible with your debt management and have a history of making on-time payments, the impact of a new loan on your credit score is likely to be less significant. To keep the impact minimal, adhere to the loan agreement terms and ensure you make timely repayments. There's a silver lining too. Timely repayment of a personal loan can actually boost your credit score. It demonstrates responsible debt management, which credit agencies love to see. On the flip side, those who avoid taking on any debt may find their credit scores are lower due to a lack of payment history. Personal loans can serve a variety of purposes, from paying off tax debts and financing home improvements to covering unexpected medical expenses. But remember, your loan rate is tied to your credit score and history. The higher your score, the lower your interest rates and monthly payments are likely to be. In a nutshell, applying for a personal loan might cause a slight initial dip in your credit score, but with timely payments, this can be improved over time. So, as we can see, a personal loan can both positively and negatively influence your credit score. So, how exactly does applying for a personal loan affect your credit score? Let's unravel this together. You see, when you apply for a personal loan, the lender conducts a credit inquiry to assess your credit worthiness. This credit inquiry is a formal request to review your credit report and falls under two categories: hard and soft inquiries. A soft inquiry, like checking your credit score online, doesn't affect your credit score. However, a hard inquiry, which occurs when you apply for a loan or credit card, can cause a minor, temporary dip in your credit score. Why does this happen, you ask? Well, credit bureaus perceive applications for new credit as a sign of risk. This perception is based on data illustrating that consumers who seek new credit are more likely to default on their credit obligations. Now, if you're applying for multiple personal loans within a short period, the credit bureaus might see this as a red flag. This could lead to a more significant dip in your credit score, as it might appear that you're desperate for funds or that you're taking on more debt than you can handle. However, this doesn't mean you should avoid applying for new credit. Remember, new credit only makes up about 10% of your total credit score. The impact of a hard inquiry fades over time, and it drops off your credit report entirely after 2 years. Another important factor to consider is your credit utilization ratio, which is the amount of your total credit you're using. If a personal loan increases this ratio significantly, it could negatively affect your credit score. But don't fret. Despite these potential impacts, your overall credit history carries more weight than a single new loan. If you've shown a consistent pattern of on-time payments and responsible debt management, the impact of a personal loan on your credit score may be negligible. Remember, your overall credit history carries more weight than a single new loan. But it's not all negative. There's a bright side to this as well. Indeed, personal loans can have a positive impact on your credit score, especially when managed responsibly. One of the key factors that credit bureaus consider when calculating your credit score is your payment history. This accounts for about 35% of your score. Therefore, making consistent, timely payments on your personal loan can give your credit score a significant boost. Consider this scenario. You've taken out a personal loan and now have a clear repayment schedule in front of you. Each time you make a payment on time, you're demonstrating to lenders that you can handle debt responsibly. This positive payment history can then reflect favorably on your credit report, leading to a higher credit score over time. Furthermore, personal loans can help diversify your credit mix, which makes up about 10% of your credit score. Having a variety of credit types, such as credit cards, mortgages, and personal loans, can show lenders that you're capable of managing different forms of credit. Hence, adding a personal loan to your credit portfolio can potentially improve your credit score. But remember, the key to unlocking these benefits is responsible debt management. This means making your loan payments on time every time. It also means ensuring that your personal loan doesn't lead to an unsustainable level of debt. If you're struggling to keep up with your payments, it might be time to reassess your financial situation and seek advice. Let's not overlook the fact that personal loans can also be a great tool for consolidating higher interest debts into one manageable monthly payment. This can help you save on interest costs, reduce your monthly financial burden, and improve your credit utilization ratio, another key factor in calculating your credit score. In essence, while a personal loan might initially cause a slight dip in your credit score, the potential long-term benefits are significant. A personal loan, when handled responsibly, can help build a robust credit profile that will serve you well in the future. So diligent repayment of a personal loan can actually enhance your credit worthiness. Now that we understand the impact, let's delve into what lenders look at when considering a personal loan application. When lenders assess your personal loan application, they consider a variety of factors to determine your creditworthiness. These factors include your credit score, income, savings, and employment history. Your credit score is a numerical representation of your creditworthiness, which lenders use to gauge your ability and likelihood to repay borrowed money. A high credit score suggests that you have a history of managing your debts responsibly, making on-time payments, and keeping your credit utilization low. Conversely, a low credit score may indicate higher risk, potentially leading to a loan denial or higher interest rates. Income is another crucial factor. Lenders want to ensure that you have a reliable income source to meet your loan repayments. They will examine your income statements, tax returns, and possibly your employer details. The higher and more stable your income, the more likely you are to secure a loan. Your savings also play a role in your loan approval. Lenders might look at your savings account to assess your financial stability. A healthy savings account demonstrates your ability to manage money and save, indicating that you are less likely to default on your loan. Lastly, your employment history provides lenders with insights into your job stability. Frequent job changes might raise flags about your ability to maintain a steady income, while a steady job history can boost your chances of loan approval. Remember, while these factors are important, different lenders might weigh them differently. Some might place more emphasis on your credit score, while others might consider your income more significant. Therefore, it's crucial to shop around and find a lender who best fits your financial profile. A higher credit score not only increases your chances of loan approval, but also gets you better terms. So, it's worth investing time and effort in improving your credit score, stabilizing your income, building up your savings, and maintaining a steady employment history before applying for a personal loan. So we've taken a loan. What's next? Well, the next step is crucial, perhaps even more so than securing the loan itself. It's time to talk about repayments, specifically the importance of making them on time. Every loan, big or small, comes with a repayment schedule. This is the agreed-upon timeline between you and the lender for paying back the borrowed amount plus interest. Sticking to this schedule is more than just a contractual obligation. It's a key factor in maintaining and even improving your credit score. That's right, your punctuality in settling debts plays a significant role in shaping your credit worthiness. You see, approximately 35% of your credit score is based on your payment history, so making timely payments on your personal loan can significantly boost your credit score. It sends a positive signal to the credit bureaus that you're a responsible borrower, capable of managing your debts effectively. But what happens when you miss a payment or, worse, default on your loan? Unfortunately, the impact can be quite detrimental. Late payments are typically reported to the credit bureaus after 30 days and can remain on your credit report for up to 7 years. This can cause a significant drop in your credit score. Moreover, defaulting on a loan is one of the most damaging credit events. It indicates to potential lenders that you pose a high risk, which can hinder your ability to secure credit in the future. In such cases, credit repair services may be needed to help remove these negative marks from your credit report. So the bottom line is, timely repayments are essential. They not only keep you in good standing with your lender, but also contribute positively to your credit score, enhancing your future borrowing prospects. Remember, a personal loan is a financial commitment. Treat it with the seriousness it deserves, and it can be a powerful tool for managing your finances and building a robust credit profile. Timely repayments can help improve your credit score over time. In essence, while a personal loan might affect your credit score initially, it can also prove beneficial. As we've learned, the impact of a personal loan on your credit score is multifaceted. It's not just about acquiring new debt, it's about how you manage that debt. The way you handle your loan repayments can either elevate or depress your credit score. A personal loan can momentarily impact your credit score due to the influx of new debt. Yet, if managed properly, it can enhance your creditworthiness by demonstrating responsible debt management. To calculate the best repayment term, a personal loan calculator can be a valuable tool, aiding in maintaining timely payments. But let's not forget, slip-ups do happen. If you find yourself falling behind or defaulting on payments, it may be time to consider credit repair services. These can help remove negative marks from your credit report, restoring your credit health. Remember, managing a personal loan responsibly can improve your credit score and enhance your creditworthiness. Subscribe to Dime Dive.